Hello everyone, this is CA Harshit Goyal from Value Sense Analytics, and today we are going to discuss a new company, Radiant Cash Management Services Limited. So Radiant is one of the leading integrated cash logistic players with strong presence in retail cash management and is one of the largest players in RCM segment in terms of network locations and touchpoints as on 31st March 2023. The company caters to a broad set of outsourcing requirements pertaining to cash management services for banks, financial institutions, organized retail, and various e-commerce players in India, and operates across five segments basically, which are cash pickup and delivery, network cash management, cash processing, cash van operations, and others. Company has recently, in FY24, has started a new vertical, which is diamond, bullion, and jewelry segment. So company came with an IPO in December 2022 at rupees 99 per share. IPO was a mix of fresh issue and offer for sale. The fresh issue was for rupees 54 crores and offer for sale was for 20 crore rupees. So let's understand the various business segments of the company. So this cash pickup and delivery segment of the company is, we will try to explain it through a diagram to our viewers. So in cash pickup model, what happens is, so let's say Flipkart gets daily cash from the COD orders it receives on its website. So it has given, its banking is with Axis Bank, and Flipkart has given the work of cash collection to Axis Bank. What Axis Bank does is, they outsource this work to Radiant, companies like Radiant in cash management services business. And what Radiant does is Radiant collects the cash from various warehouses of Flipkart or the cash centers of Flipkart every day, and they collect and deposit that cash with Axis Bank. So this is cash pickup model. Similarly, the cash delivery model is, suppose an NBFC needs 50 lakh rupees cash from its banking partner to disburse loans. So bank directs Radiant to give that cash to NBFC. So Radiant will deposit rupees 50 lakh rupees, will provide 50 lakh rupees to NBFC, and bank will reimburse that 50 lakh rupees to Radiant. So this is their cash delivery model. In the network cash management business, cash is deposited in Radiant's bank account in locations where client does not have a bank branch and subsequently transfer funds electronically. The cash van operations they have also started recently, in which they provide armored van with full crew comprising driver, armed guards, cash custodian on short or long-term lease, mostly to banks for their own bulk handling of cash between branches and vaults. In cash processing, at the end user request, cash is counted and verified at the time of pickup for an additional fees. So this is their segment-wise information, in which segment contributes how much to their sales. In FY23, cash pickup and delivery was 69%, network currency management contributed 18%, cash processing 5%, cash van 6%, and others 2%. So in last 9 months in FY24, more or less the segment data is same. Cash pickup has slightly come down from 69% in FY23 to 63 to 66% in Q3. Network cash management 19%, cash processing 5%. Cash van operations is picking up as a contribution to sales because they have been consistently adding new vans since IPO. And others is at same 2%. So now let's try to understand the pricing model in each of these segments. So how does the pricing work? Basically, cash pickup and delivery charges are fixed amount per point per month. So prices could range from rupees 2,000 per month per point to rupees 25,000 per month per point at higher end and rupees 2,000 at lower end. That depends on the daily cash limits. Higher the limit, higher the price. Average realization of Radiant is around rupees 5,000 per month per point. Network cash management business is purely a volumetric business. say rupees X per thousand. So they are currently charging at rupees 1.3 to 1.4 per thousand of cash deposited. The total cash they handle, out of that, 35 to 40% of cash handling goes into network cash management segment. In cash processing, they charge 0.4 paisa to 50 paisa, 40 paisa, 50 paisa per thousand. In cash van operations, they receive rupees 1.5 lakh per van per month. So this pricing of 1.5 lakh is based on 8 hours per day and 2000 kilometers per month. If the vans are used more than that, more than 8 hours per day or more than 2000 kilometers per month, then they charge extra for that. So most of their contracts with their customers are long-term contracts, generally 3 years, and after 3 years, they revise it periodically. Price revision doesn't happen on yearly basis. It's because the industry is very competitive and the rates are also low and kind of fixed. So the price hike does not happen very often. Last time it happened in 2021 and before that in 2016. So growth of the company is not dependent on raising prices every year, but rather on how many points they add and how many customers they add. So this graph basically shows, this data basically shows the company's footprint across India. Now they are present in 28 states and 8 union territories. As on 31st December 2023, they have reached 67,000 plus touch points, which was 63,000 in March 2023. And they have reached 14,000 plus pin codes. So they were roughly around 13,000 pin codes in March 2023. So they have grown their number around 7-8% in terms of touch points in the past 9 months. They are mostly present in Tier 2 and Tier 3 cities. 80% of their touch point and 83% of their revenue comes from Tier 2 and Tier 3 cities. This map shows in which state they have how many touch points. So top 5 clients contribute around 60% of their company's sale. This is pretty consistent. In FY23 also it was 60%. In FY22 it was 66%. So from there it has come down to 60%. So they have gained some new customers, meaningfully contributing customers in the past 2 years. Top 10 clients contributed 89% in FY22 and now they are contributing 81%. And revenue from Tier 2 and Tier 3 towns was 87% in FY22 and it has come down to 83% currently. These are the name of some of the marquee clients: ICICI Bank, Kotak Bank, Yes Bank, Standard Chartered Bank, IDBI Bank. So as you can see, there's only one PSU bank here, SBI. And the reason behind this is that no other PSU bank, other than SBI, no other PSU bank provide cash management services to their clients. That means that if you are a customer of a bank other than SBI or a PSU bank, say Union Bank of India or Bank of India, or any other bank, PSU bank, then the customer themselves have to deposit their cash into the branch of the bank. Bank does not provide cash pickup service. PSU bank does not provide cash pickup service. So this data here shows the key performance indicators of the company. Now look at their customer base. It has increased from 56 in FY21 to 127. In the past 2 years, they have almost doubled from 65 to 127 customers. End customers have also increased from 2600 plus to 3326 customers currently. Here's the data of pin codes. Why this data of pin codes and touch points here? We can see the touch points 42,000 to 67,000, more than 50% growth in the past 3 years. Why it's important is because the revenue growth is directly proportional to the number of touch points the company caters. Since there is no price revision and the contracts are mostly long term. company has been consistently increasing their touch points, 42, then 49, then 63,000, then 67,000 recently. And here we have the tier 1, tier 2, tier 3 data, that how much customers have increased, how much touch points, how many touch points have increased in which segment of the city, tier 1, tier 2, tier 3. So growth in tier 1 and tier 2 have been more in the past 3 years than tier 3 cities. Company's cash van has also increased from 694 to 870. So one data here, interesting data, is that before the IPO, company did not own any single of their cash vans. All the vans were leased. So what they did after IPO was that they planned to purchase around 200 plus van of their own. Out of 900,000 vans, whatever they will have, out of that 200 plus vans they will purchase now. The reason being, they wanted their vendor risk to minimize. Suppose someday in the future, their cash van provider does not provide them van for any XYZ reason, then the company will have their own vans to keep the continuity of the business. So that's why they have decided to purchase 220 something vans on their own books. And after that, additional vans, whatever that will come, they will come on lease basis only. They will not buy their own vans more than that. So here the data of management parameters, like how many employees are there from ex-armed forces. So this is also very good data, that like cash loss as a percentage of movement has been very low for the company. So it's less than 0.0024%. And look at the insurance premium paid, it's around 3 crores, 3.7, 4.4, 4.2 crores. And cash loss in amount is 1 crore in 9 months. Last year it was 6 crores. Before that it was 1.8 crores. Before that it was 3 crores. So company has done very well in taking care of its operational risk. Now coming to the new segment in which the company is entering, the diamond, bullion and jewelry segment. So this is the last mile support the company is going to provide. Like how does the gold supply chain works? Gold is imported to India, into the banks, into the vault, then it's transferred to production center, and then it's transferred to the hallmark center, from there to the retail stores. It's a 1,000 crore rupees plus opportunity for the company, which is 47% organized and 53% unorganized. So the new investment company is making in the DBJ segment can help the revenues of the company, can provide the good growth to the company's revenue. Only 2 organized players are there in the sector. So competition is fairly less for the company, and they can grow easily into this company. As per one of the management interviews, company intends to have more than 300 crore rupees revenue in the next 3 years from this segment. Now, company has also invested in a company in Kerala, Aceware Fintech Services Private Limited. So their app is Ace Money. So this company, through this acquisition, what Radiant wants to do is provide the IT solutions to the cooperative banks in tier 2 and tier 3 cities. So this sheet gives you the idea of the market size, like 1 million cooperative societies are there, 96,000 plus cooperative banks, 10,000 plus NBFCs, and 70 million plus neighborhood shops. So what the company will intend to do with the subsidiary is that they will provide basically last mile banking facilities through there. They'll install QR codes, mobile banking kiosks, micro ATMs in the locations where the banks are currently not present. And it's also very heavily subsidized by the government currently. for to increase the financial inclusion in India. For example, in the Ace Money, like the POS machine or the micro ATM, if you install in tier 2 and tier 3 cities, then 75% of the cost is reimbursed by the government as subsidy. And out of 75% of that cost, 75% of that subsidized cost is provided instantly. And the remaining 25% of the subsidy is provided after 1 year. And there are certain conditions which have to be met, that like minimum 50 transactions needs to happen in the quarter. So if all those conditions are met, then 25% of the money is given after 1 year of the installation of the machine, and 75% of the subsidy is provided instantly. RBI has big plans for financial inclusion. So basically through this, what the Radiant is trying to do, that every retail shop, every kirana shop can become a micro ATM. This is the revenue channels they can get from Ace Money. Now, like we can see that there are related party transactions in the company. In one of, like, they take their guards and drivers from the group company Radiant Protection. Now, the reason of doing that is that why the guards and drivers are not on the books of the Radiant CMS, and while on their related party company Radiant Protection, is that you need to have a PSA RA license if you want to have guards. So Radiant Protection has a PSA RA license, that is Private Security and Regulations Act. Now, why the PSA RA license cannot be taken into Radiant CMS is because PSA RA company cannot have a foreign investment, and hence it is kept in a separate company. Now, few of the positives in the company which we will look here is that 75% of the let's look at the financials first. Then we will talk about the positives in the company. So, company is a 900 crore market cap company, currently trading at 84.4 rupees, 52-week high of 114 and low of 73. So this is the profit and loss of the company for the past 6 years. Revenue has grown from 195 crore in 2018 to 355 crore in 2023, and profit has grown substantially from 5 crores to 63 crores. What's interesting is the consistent high operating margins from 24%, 27%, 28, 27, 30, and recently in the past 3 quarters, it has come down to 19%. And reason of that is, first of all, is slow growth in the revenue, and secondly, their higher OPEX due to introduction of the DBJ segment, diamond bullion and jewelry segment, and all the costs are upfront, the employee cost, the van cost, and revenue will start building up from the next year. This is the company's balance sheet. Company is debt free, minimum 27 crore rupees of debt and more than 139 crore rupees of cash in the books. So net debt free this company is currently. Company has consistently positive cash flows and operating cash flows 97 crore, 14, 40, 28, 31, and 74. Good growth in the past 3 years in cash flows also. These are the quarterly numbers of the company. Sale has been stagnant in the past 4-5 quarters at around 90-100 range. Margins has come down from 25% to 17%. It was 14% in September, but since then they have picked up to little bit, and management is guided for better margins going forward also. So now coming to the positives of the company, 70% of the recurring revenue. So this gives very high quality of earnings to the company. Industry growth, industry is set to grow at 20% CAGR for the next 4 years. The industry structure is like that there are only 6 qualified players, of which only 2 players have a strong pan-India presence, where there are 39 banks who offer CMS as a service. Company is diversifying its revenue stream and have created new customers. They plan to increase the direct sales from 4% to 10%. They have increased. Cash van revenue has increased to 8%, and they plan to add 250 vans in FY24 and 25. They have also made strategic expansion into DBJ. The expansion of the valuable logistics is expected to create new avenues of revenue growth and bolster their overall market position. Then we've already discussed their acquisition in the Aceware fintech services. So currently the Aceware is only limited to Kerala, but since Radiant has pan-India presence, they are taking their services pan-India from Kerala to Tamil Nadu and other southern states currently. So there's a lot of under-penetration and a long runway of growth for this segment and company in particular. The service in an extremely under-penetrated sector. India has 1.2 crore retail outlets. The estimate about 30 to 40 lakh outlets are eligible to use service of this nature, but the entire industry is catering to 1.5 lakh outlets only. With the oligopolistic nature of the industry and long runway available, these companies can comfortably grow in high double digits for the foreseeable future. Long-standing relationships with key clients, marquee clients like Standard Chartered Bank, Deutsche Bank, State Bank of India, IndusInd Bank, Axis Bank, ICICI, Kotak, HDFC, have been availing the cash management services to Radiant for over a decade, and the volumes have grown consistently over the years. None of these esteemed marquee clients have ever discontinued service with Radiant. In the past 5 years, company has consistently given high operating margins of more than 25% and high ROCE of 30% plus. Company has positive cash flows for operations over the years, strengthening balance sheets, and is net debt free. So company has a very healthy financial position and robust financial metrics. Now let's look at some of the risks of the company. Company, 95% of the business comes from banks, but that's the nature of the industry. Its growth is dependent on the banking sector. Customer concentration. Over the years, we have seen that their top 3 clients have consistently contributed to their revenue, with the largest client being a significant contributor. If one or more of key customers were to suffer deterioration in their business, the revenues could decline. Decline in use of cash, a decrease in the availability of use of cash as predominantly mode of payment in India could have an adverse effect on the business as cashless payment systems gain traction. Vulnerability to regulatory risk. The current demonetization measures had a significant impact on the cash circulation in India, and there's uncertainty whether similar unanticipated measures could be adopted. Hence, the future remains unpredictable. The cash management services has been regulated by the RBI with regular interventions and increasing compliance requirements, leading to increasing cost for the ATM service provider. Business vulnerable to cash loss risk. Given the large volumes of cash handled, the firms are exposed to various operational risks, including armed robbery and customer or third-party fraud, theft, or embezzlement by employees, or reporting errors, both deliberate and inadvertent, and failure to meet specific requirements under applicable service agreements for which they may incur penalty charges. But we have seen that company has kept the cash loss very minimal. So they are doing fairly good in this regard. Now, coming to the management of the company. So management currently holds 56% stake in the company. So company was started by Colonel David Devashyam. He's the chairman and the MD of the company. He has over 24 years of experience in the Indian Army and over 16 years of experience in the company. So this is the list of the directors of the company. And this is the list of the management team. Colonel Benz K. Jacob is the CEO, over 28 years of experience in the Indian Army and over 14 years in the company. TV Venkat Ramanan is the CFO of the company, and he's associated with the company since August 2021. So it's been more than 3 years now. Coming to the valuations of the company, so company currently has an EV of 760 crore rupees and EV of EBITDA of 10.87 times, market cap to sales of 2.38 times. Now this compare these figures to the other listed peer of the company, CMS Info Systems. It has CMS Info has EV enterprise value of 6,450 crores, EV of EBITDA of 12 times, market cap to sales of 3.34 times, and P multiple of 20, where Radiant has a P multiple of 17. Growth in PAT has been 20% plus in the past 3 years and 60% plus in past 5 years. EBITDA margins consistently above 25% and good growth in cash flows in the last 3 years. So company is available at a reasonable valuations considering the growth plans they have in the future and the high quality of earnings company has. Management has guided for 20% plus growth in the coming years and improvement in margins from the current level. Thank you.